In this video, we'll be looking at the Trade Weighted Index, the TWI, which is still part of exchange rates. In terms of the syllabus, we are living right here under measurement of relative exchange rates. So how are exchange rates measured? So there is not one single exchange rate for Australia. We've got many exchange rates that tell us what's happening with our currency. For example, there are bilateral or cross rates, so one country's currency in terms of another. So the Australian dollar in terms of US dollars. One Aussie dollar buys 77 cents or whatever the value is at the time you're watching this. The other way we measure exchange rates is in terms of the Trade Weighted Index, also known as the TWI. The TWI gives us a much better overall picture of the value of the Australian dollar. So the TWI, in terms of the definition, is a measure of the Australian dollar against a basket of currencies that we trade with. Each currency in the TWI is weighted according to its importance to trade with Australia. So let's think about it. Why do we care about this measure called the TWI? Well, it's more accurate of how strong the Australian dollar is because it takes into account its strength against a bunch of trading partners which are weighted according to how much trade we do with them. So for example, in terms of the TWI, if we're looking how it's calculated, the significance of exchange rates with the US and Japan have declined, while the exchange rate with China has become more important. Think about it this way. If the TWI improves, then the Australian dollar is stronger against the currencies of our major trading partners. Likewise, if the TWI declines, then the Australian dollar is weaker against the currencies of our major trading partners. So you might say, well, what are the weightings in the TWI? So this information is from the RBA, and you can see here that the Chinese currency is about 26% weighting in the TWI. The US dollar is about 11.5%, Japanese yen 10.4%, and so on down there. So you can see that movements in the exchange rate with China occupy about a quarter of the movements in the TWI. So it really reflects who we are trading with in the global economy. So one common question that's asked is, why is the TWI a better measure of the Australian dollar than the traditional US Aussie dollar exchange rate? This is a good question. So the TWI gives us a much broader measure of the Australian dollar's strength because it's weighted according to the other country's importance to our trade. So we're not just looking at one economy, we're looking at all of the major economies we trade with, and then how is our dollar doing? The US Aussie dollar exchange rate, while important and quoted very often, just shows the strength of the Australian dollar against one country, America. The TWI shows the strength of the Aussie dollar compared to the most important countries, the ones we sell exports to and the ones we buy imports from. So it's a much better indicator of the strength of the Australian dollar. Again, if the TWI improves, then it shows the Australian dollar is stronger compared to our major trading partners. If the TWI declines, okay, the Australian dollar is weaker compared to our major trading partners. And that's an introductory look at the TWI.